Welcome to the Cambridge Forum discussing challenges of globalization, global engagement. I'm Roger Owen, Professor of History at Harvard University. As the United States military engagement begins to wind down late in the last decade, a new global threat to America's sense of security emerged: economic recession. In 2008, meltdown of domestic housing and financial markets shook the international economy to its core, exposing weaknesses that now threaten not only a global recovery, but also the US economic recovery. Here to talk about the impact of the European debt crisis is Richard Parker. Richard Parker is lecturer in public policy and senior fellow at the Shorenstein Center at the Harvard Kennedy School of Government. An Oxford-trained economist, he's been active in journalism, philanthropy, social entrepreneurship, and political consulting. And from 2009 to 2011, he was an economic advisor to Greek Prime Minister George Papandreou. His books include The Myth of the Middle Class, an early study of widening US income and wealth distribution; Mixed Signals, The Future of Global Television, a critical assessment of the spread of satellite-based news and its political impact; and most recently, the intellectual biography John Kenneth Galbraith, The Making of American Economics. His articles have appeared in numerous professional and mainstream journals, including the New York Times, New Republic, Nation, Harper's, Le Monde, Atlantic Monthly, and International Economy. Welcome to the Cambridge Forum, Richard Parker.
Thank you so much for that very kind introduction, and thank you, ladies and gentlemen, for coming out on a day like today, although I must say this is one of the pleasanter February afternoons in Boston history that I can remember, at least since I've been here. What I want to do is talk out of my experience as an advisor to Prime Minister Papandreou and explain to you why I have a significantly different understanding of what is referred to as the Greek crisis here in the United States, and in fact in large parts of Europe. Let me start by addressing several common understandings, which I suspect most of you or many of you share as truths about Greece and the Greek economy. You know, for example, that the Greeks don't pay taxes. You also know that they don't work very hard, that they're anti-business, and that their government is bloated, and that since the beginnings of the massive aid received from the Europeans and the IMF, almost nothing has changed. Let me try to explain to you why each of those is utterly wrong, and in explaining why it's wrong, suggest to you a different analysis of what's going on in Greece that I think gives a broader understanding of Greece's place in this larger economic crisis in which we are all still living. The Greeks don't pay taxes. In fact, the Greeks pay approximately 35% of GDP, which is a little below the average for Europe, and actually above the percentage of GDP paid by Americans in taxes. How is this possible? Well, first of all, the Greeks collect taxes in several ways. One is through value-added tax, another is excise tax, and a third is Social Security taxes on wages, which cumulatively get them to that 35% level. It is true that income tax is collected at a lower rate than in Europe or the United States on average, but in the last 2 years they've been making significant progress and have brought the difference in terms of share of GDP up from about 2% to 4.5%. In other words, more than doubling their rate of intake of revenue through income taxes just in the last 2 years. The Greeks don't work very hard. Well, actually, OECD says that the Greeks work the longest total number of hours, the most total number of hours per year of any West European country. In other words, Northern European countries offer longer paid vacations, longer leave times, and the Greeks, by contrast, have shorter leave times and shorter vacations, and tend to work longer hours over the course of the day, starting later in the morning but going well into the evening, as anyone who's visited Athens knows, when he or she wants to go out shopping at 10 o'clock at night and finds almost all the stores still open. The Greeks are anti-business. This is a peculiar concept because the number of entrepreneurs as a share of the population is higher in Greece than in any other country in Western Europe again. In other words, Greece's economy is singular in the sense that it resembles the 19th century American economy because it is dominated by thousands upon thousands upon thousands of small entrepreneurs. Anyone who's been to Greece has seen the taverna or the little shop or the little pharmacy or any other sort of small neighborhood business, which is run almost universally by family, extended members of a family. And as a consequence, the number of entrepreneurs outpasses, as a percentage of the workforce in the United States, the percentage of 3 to 1. In other words, for a country like the United States that prides itself on promoting entrepreneurship, the number of small business people in the United States is a third what it is, basically, of what it is in Greece on a per capita basis. So the idea that the Greeks are anti-business comes across as an odd accusation. No change so far in government. Well, in fact, in the first year alone, the Greek government was able to reduce its share of spending in the Greek economy by 5 percentage points. That's far more than the United States or the United Kingdom, both of which have been running deficits at the same high levels as the Greeks have been able to accomplish. And they continue to press forward so strongly that the IMF is estimating that later in 2012, it's quite likely that the total primary surplus of the Greek government's primary surplus will be in balance, meaning that the direct day-to-day operations of the Greek government will be covered by revenue, and the uncovered portion of the Greek government's crisis will be the payment of old debt and interest on that debt. So we've moved in the space of less than 2 years from a crisis of much larger proportion in some ways to one that, in terms of progress measured by the IMF and the EU, which have been watching over the situation quite carefully, to manageable improvement. Now, all of this, it seems, is in conflict with the things that you probably saw on television last night or read about in the papers this morning. But it's the case that those demonstrations in Athens tend to be viewed with a narrow television lens. I've more than once found myself in Athens at the time of passage of major austerity legislation when large crowds turned out in front of the parliament, and staying in a hotel 6 blocks away, life in Athens goes on as normal. Nothing, in fact, outside the immediate perimeter of the parliament seems to reflect the kind of overt hostility that leads to violence that we've seen so prominently displayed in television and news reports over the last 2 years. That doesn't mean that the Greeks aren't angry. This crisis has completely delegitimized the current political system. The government of George Papandreou, PASOK, now has a popularity level below 10%. His chief rival, Anton Samaras of the New Democracy Party, is a little under 20%. And 2 previously small left parties, one a relatively unreformed old communist party that dates from quite a long time ago, the other more contemporary new left party, between them now claim the loyalty of over 40% of Greeks. So politics has definitely been reshaped, at least in theory, by this crisis, and will probably, over the next few years, result in significant party realignments. But it's not the case that the Greeks are ready to leave the Eurozone. In fact, I was looking at polling over the weekend that continues to show that 70% of Greeks or more insist that they want to stay within the Eurozone. The problem is not the goal, but the means. And the problem from the point of view of the Greek government, and from my own conclusions working with the Greek government that included time spent negotiating with the IMF as well as the private banks who were principal private bondholders of the Greek government, is that we fundamentally misconstrued the crisis. In a sense, this story is not primarily about Greece's moral turpitude or lack of managerial ability when it comes to handling its public finances, but rather that Greece is in fact roadkill, collateral damage on the highway of the global economic crisis that swept out of Wall Street 3 years ago, and which in some sense is still not resolved. Let me explain what I mean. Greece's economic system was not the system that you've heard so much about, in which debt was spiraling out of control. Debt to GDP ratio in Greece for almost 15 years was stable at about 100% of GDP, a high ratio, but one that was manageable because Greece was among the fastest growing economies in Europe. For more than 12 years, it averaged over 4% growth, which was a phenomenally rapid expansion of the economy and allowed the Greeks to service their public debt load. What happened in the aftermath of the Lehman meltdown was simply that banks and others who were buyers of public sector bonds began to look around nervously to see what might be a vulnerable next victim of the loss of confidence in markets that was so central to the Lehman meltdown. And Greece came up very quickly because it was a small economy. It was running a fairly large current account deficit. And at the moment that George Papandreou took office, he decided in terms of establishing a new regime in Greek politics, one of openness and honesty, that he would reveal that the expected deficit of the Greek government that he was taking over was not going to be the 6% of GDP that his conservative predecessor had said it would be, but something over 10%. Now, in truth, I know what some of the reasoning was behind Papandreou's decision to go public. It wasn't obviously just about open and honest government, although that was a major part of the Papandreou platform and something that he still quite honestly and passionately believes in. It was also the recognition that the admission of the larger deficit and the larger consequent debt to GDP ratio would help drive through a series of reforms of the Greek government, reforms of the Greek economy, that by almost universal acclamation have been needed for some time. It isn't fair to talk about the Greek government as being bloated if what one is talking about is labor force. As a share of the total Greek labor force, the public sector is about a fifth, 20% of all workers in the economy, which puts it right at the European average and only slightly ahead of the United States. So bloat in terms of number of people working for Greek government is not the problem. Inefficiency, however, is. Greece has lagged behind disastrously in terms of computerization of government functions, so much so that the office that keeps account of 7 million Social Security records was, when I arrived 2 years ago, maintaining those records on paper with pen and typewriter. The Central Finance Ministry, which is responsible for both formulating and administering Greece's budget during any given fiscal year, had no computerized budget or budget record keeping that would allow it to adapt the budget as circumstances warranted within the year, and in fact relied entirely on the ministries to which it allocated funds without significant follow-up to make sure that the funds were well spent. So in other words, the Greek government was in effect very inefficient and prone to corruption, and was a source of enormous dislike among the Greek people. At the same time, the Greek people carried about them a story about their own widespread corruption, the consequence of several hundred years living under the Ottoman Empire, which had left behind a sense that central government in any form was not to be trusted, and that government and the wealthy were always trying to evade the rules or line their pockets, and so it was all right for the Greeks themselves at every level of society to do the same. What George Papandreou recognized was that this was a mentality, a cultural attitude, that by itself couldn't be changed by a simple body of legislation that reformed government structures, but required what amounted to a psychological, moral, and political campaign against Greek culture as it then existed. The tragedy is that in the process of openly and honestly admitting the size of the Greek deficit, He did so at a moment that turned that admission into the leading edge of what has been so far a perfect storm. What do I mean by that? What happened in the early months of 2010, after Papandreou's acknowledgement of the size of the deficit, was that Greece's ability to borrow virtually collapsed. Interest rates on bonds began to soar past 10% for short-term bonds and made it impossible for the Greek government to go out into the market to refinance or acquire new funds to carry on its governmental functions. In so doing, it left the Greek government with a crisis of which there were two choices. One of which was to turn to European allies and the IMF for aid, the other of which was to, in effect, to declare bankruptcy for all intents and purposes and default on the body of outstanding debt that they already had. The latter was not really a political option for Papandreou, nor was it an acceptable option for the Greek people. And in fact, what happened was that the Europeans, recognizing the contagion effect that the Greek crisis represented, stepped forward with more than $150 billion worth of aid in the spring of 2010. But almost all of that aid, which has been doled out at 2-month and 3-month intervals since then, was premised initially on expectations of a European-wide recovery, and in fact a global economy-wide recovery, that hasn't taken place. You have to understand that the Greek economy is especially vulnerable to the global economy because the two largest sectors in the Greek economy are shipping and tourism. Shipping has seen shipping rates over the last 3 years fall by 90%, and they remain depressed at about 90% of their levels of 2008, even today. So global shipping rates have not recovered. The second is tourism, and it's not really within the Greek economy or the Greek government's control to shape the decisions of British, German, and Swedish tourists about whether or not they want to come to Greece to spend a summer holiday. And in fact, what's been contributing in the last several years, although it's improved in this last summer, has been the unwillingness of Northern European tourists to leave their home countries because of their own fears about the economic conditions of their countries and their likelihood of maintaining their jobs or maintaining their homes. And so Greece has been caught in a much larger web of fundamental macroeconomic underperformance over which it has no control. The second way in which Greece has proved to be collateral damage of this larger financial crisis is that in agreeing to refinance the banks here in the United States and now gradually refinance major banks in Europe, there's been no significant reform that has gone with the refinancing. And so as a consequence, much of the money that has flowed in the United States from the Treasury to the major US banks has flowed then not out, as a Keynesian economist might expect, into loans to commercial businesses or households and the like to restart the economy, but rather to hedge funds and to the trading floors of the banks themselves so that they can essentially game markets such as the commodity market in the third world and the sovereign debt market in the first world. In other words, what we've done is by refinancing our global banking structure is maintain the very fragility and the reasons why states throughout the world are suffering still in the wake of this enormous 2008 meltdown. Now, what can we say about Greece today? Very little, frankly, that's hopeful. The kinds of cuts that you saw taking place, being passed by the Parliament yesterday, are going to be followed by further cuts undoubtedly. It is clear, or reasonably clear, I think, that the Europeans are going to step up to a second major aid package. What everyone recognizes, however, is that this aid package will in no way reduce the debt to GDP ratio, which is such a crucial factor for the Greeks, if they're meant to service even more debt that's being offered to them by these public entities. My own reading of the Europeans' motivation and my own reading of what I think is going to happen over the next 2 to 3 years, however, depends on a fact which doesn't seem to be widely recognized in the press. And that is that what's going on right now is that the bulk of the external debt owed by the Greek government is being taken out of private hands and placed in public hands. And once in public hands, the likelihood that that debt and the prospect of default might contribute to contagion in private financial markets will be substantially lessened. So from the point of view of European leaders and from financial sector leaders, there's an enormous difference between who holds the debt, irrespective of the debt level. What we have to understand, though, is that there is no reasonable way to expect that the Greeks are ever going to be able to repay the level of debt they are now carrying and will be carrying over the next 20 years. So what we should expect is that Greece will ultimately default. Whether it will be a messy default or an organized and orderly default is really the question. And when it takes place is the other. If it can be delayed for 3 to 5 years, and if it can be handled in some orderly fashion that signals that, in fact, Greek financial institutions and the Greek economy can survive the write-down and the blows to confidence in the Greek markets, then, in fact, Greece will be able to escape this situation. If it cannot, if the default ends up being disorderly, and only worsens market confidence in the Greek economy and Greek political leaders, then it will be a real disaster. The reason that the Greek government has worked so hard to avoid being thrown out of the euro and back onto the drachma is fairly simple. If they leave the euro and go back to the drachma's value will fall by 100% or more within a day or two of leaving the euro. That is, that the value of the Greek currency, whatever it's called, will be significantly less than the euro that the Greeks had held. But the debts that will pass from the old monetary system will still be in euros, which means that the amount of money owed in the new drachmas will be vastly more than what was owed in the old euros. Secondly, that the lifeblood of the Greek economy will now also cost vastly more. You have to understand, Greece has no domestic oil or natural gas production. Greece has no capacity to produce vehicles, whether cars or trucks or buses. And so at a very fundamental level, the operation of a modern or semi-modern society, which Greece is, depends on access to petroleum, depends on access to vehicles, depends on the ability to move goods both domestically and internationally. Then a return to the drachma or some other named currency would make that nigh unto impossible for all but the very few of the wealthiest in Greece and the most successful of the outward-facing Greek firms. So while what is going on is in no way morally acceptable, it may be the least of all possible unpalatable choices. It's fairly likely that Greek unemployment will remain at 20, perhaps even 25% for 3 or 4 more years. It's likely, however, that in that period there will be significant reforms made to the Greek government that will have lasting effect in terms of the Greek government's efficiency and competence going forward. And it may well mean that the Greek economy will become more like the West European or American economy, which cuts with its own sort of ambivalence for many of you, I'm sure, meaning there will be fewer small entrepreneurs, more chain stores, and more likelihood that the chain stores will be owned by the Germans or the French or the Dutch or the Swedes. In other words, a loss further of national autonomy in the global world, and the introduction of large-scale enterprises in a country whose very culture is dependent on the neighborliness of small-scale enterprise. But once having joined that world so many years ago, it's a reminder to us of the near inescapability of a member of the globalized economic system. And it's a reminder, too, when we understand that so much of what has happened in Greece is not a function of the moral failure or incompetence of the Greeks, but damage done systemically by larger forces that Greece cannot possibly control, that we are all called upon to ask the question, what will it take to control those forces? Thank you.
Thank you very much. Do you want to stand or sit for questions?
I'm fine.
Okay, I'll ask you the first one. I mean, a comment first. I think part of the folklore of Greece is that they have more public holidays. I remember the Economist table, which must have done irreparable damage, saying they had 28 days off as opposed to 7 in the United States or something or other. But that's more a comment. What I'd like to know a bit more about is how this is viewed from Brussels. Is the current European thinking among the people who matter, like Merkel and Sarkozy, that they would be better off ditching Greece or keeping Greece?
I think we're in the middle of seeing attitudes change. What I can tell you is that as recently as the October negotiations in Brussels, in which I was deeply involved, it was quite clear that the senior European leadership did not want to face the prospect of Greece leaving the euro because they thought that the systemic, disorderly consequences of it were far greater than the cost of public financing of a new regime. I think in the last couple of months, however, that attitude has begun to shift as they see this so-called PSI deal get put together, where the current private bondholders take a nominal cut of 50% in their bonds, and a new round of troika financing comes into play. At that point, as I've tried to suggest, what's going to happen is more and more of Greece's debt will be in public hands, and therefore less likely to disturb private financial markets. And that will be the moment at which I think it's fair to say you should not, in Athens, count on further European funding of any sort, and that if you do have to leave the euro, people will be on the dock waving bye-bye.
I mean, it's also, just to throw into that mix, isn't it, that both Merkel and Sarkozy are up for election, and that the European leadership might change, I suppose. One has no way of knowing whether there'll be more or less pro-Greek, the new people.
Well, I don't even think that it's if you're willing to accept my argument, and you don't have to, the thrust of what I'm saying is it doesn't matter who's in power in Berlin or France in terms of being pro-Athens or not. It's rather that they, in Europe as in the United States, have failed still to get control of the volatility and the mercuric character of global finance. And until they do, the likelihood that a new meltdown will strike in new and unexpected ways remains, and remains quite large.
Questions from the floor? We need to come, but second after, yes.
So how would you suggest the United States and people who manage the Eurozone get control of those outside forces that are driving Greece and perhaps the rest of us into a tailspin?
Well, look, I mean, I think what I want to do is first suggest that from the late 1940s up through the mid or late 1970s, Western Europe and the United States and Canada and Japan went without a single major financial system crisis. So what we have then is a recent history to look back on to say, gee, perhaps in fact we could create an environment of political regulation or public regulation, if you will, that might go a long way toward limiting the prospect of another major financial meltdown. What were the components of that system? First, on the domestic side, commercial and investment banks were separated by the Glass-Steagall Act, so that the habits of mind that are those of investment bankers and whose risk-taking instincts are in some sense inimical to success in commercial banking are no longer joined. We separated those two functions in the 1930s, and I think by and large economists would agree that it was a major part of why you had relative stability, because the big commercial banks were not allowed to act as if they were investment banks, placing large bets that might very well go bad. There's a second, which is the so-called non-banking or shadow banking sector has grown up since the 1970s and needs to be re-regulated. Thus, for example, GE Credit came under the protection of the Treasury and the Fed when in fact it's a branch of an industrial corporation, not a bank. But the truth is that GE Credit or GMAC or Ford Motor and the like perform the functions of banks in numerous ways, but escape the kind of banking regulation that is meant to maintain the stability of the banking system. And so often we found that in the mortgage field, the emergence of these so-called mortgage firms that were not banking institutions and therefore not closely regulated in ways that banks were, meant that they were able to drive into markets in ways that forced banks to seek to behave like non-regulated institutions, which upped the ante in terms of fraud and misdeeds that we're finding have been spread all throughout the mortgage funding industry. There's also an issue about the credit rating agencies and whether or not they deserve the kind of special exempt status that they currently enjoy under federal regulation without, it seems, much responsibility or liability for failures of due diligence, which is at the heart of what they do. In the past 20 years, we've seen several of the great accounting firms of the United States go belly up as a consequence of their association with massive fraud. Enron is a perfectly good example. But nothing similar is the case with these credit rating agencies, although their role is not unlike that of an auditing firm, an accounting firm, meant to secure the confidence of investors based on those facts. Finally, there are the hedge funds, which essentially are entirely unregulated by the SEC, and which at the time of the 2008 meltdown had something like $2 trillion of money under management.
Thank you. I want to follow up. Do you see any political will toward regulation anywhere in the world?
I see mixed political will. I mean, I think that the Dodd-Frank bill represents the kind of mixed political will that characterizes both the Obama administration and Democrats and Republicans in the Congress. There is in Dodd-Frank a structure of a reasonably strong systemic risk limitation, but how well it is applied and how well, once the rules are set, those rules are enforced and institutions monitored remains to be seen. And that's the great unknown currently.
I have 3 questions. Mr. Van Everen first. If you can come to the microphone, and then I have you in line.
Sure. I'd like you to comment on 2 views we often hear about the European crisis. The first is that it's been made worse and perhaps lengthened, maybe even it happened because of a misapplication of austerity in a situation where stimulus was required. And the examples people give are that Mr. Trichet, who was head of the European Central Bank, was slow to lower interest rates when the recession started. And then he raised rates twice there in 2011, well before the crisis was over, which if you're a Keynesian, you would have done the opposite. We see in Northern Europe an anti-Keynesian view toward the whole problem. We see the British, Cameron, imposing austerity when a Keynesian would have said, do the opposite.
There's a British colleague of mine said one of the fine minds of the 18th century at work there in Mr. Cameron.
Yes, exactly. And then regarding Greece, sort of an opposite view of how to handle the matter is to help the Greeks outgrow the mess they're in by stimulating their economy instead of imposing austerity, which will strangle it, which will increase the deficit, which is at the root of their problem. So to what extent do you see this crisis in Europe essentially as a, if you will, problem of bad ideas, of a misapplication of false economics when we really learned the lessons of Keynes and how to get out of messes like this back in the day in the 30s? Second, you just were talking about the problem of bank regulation and an under-regulated financial sector and how for decades we had things were good. We didn't have financial crises, and then we undid the regulations of the 30s, and we've had all this trouble. Can you say more about how under-regulation of finances helped make things worse in Europe in particular?
Mm-hmm. So I think that there were Keynesian lessons to be learned from the period from the 30s through the 70s, and they're fairly strong, and I don't think that it's contested that they were in large measure rolled back as guiding principles, although certainly under Republicans, whether George Bush, his father, or Ronald Reagan, deficits were extraordinarily high. In fact, I am reminded that the last Republican president to actually balance a budget was Dwight Eisenhower. So for a party of fiscal responsibility, their batting average seems a little low to be aiming for the World Series, as they seem to be in their claims about responsibility. There's another aspect to this. Keynes was not so much a man of regulation. He was a man of sort of macroeconomic stimulus and the role of the government in counter-cyclical or pro-cyclical activity. Much of the banking regulation philosophically predates Keynes and in some ways comes out of the progressive era. And I think that what we need to do to get back to that sort of thinking is, again, open up and deepen the debate about what has not been done under Dodd-Frank and make it an issue of public education as widely as possible over the next 2 to 3 years. I don't expect major steps forward in terms of new public regulation anytime soon, but if, as I fear, we're likely to have more smaller crises ahead just in the next few years, I think that the pressure of the public will build toward a stronger regulation. Now, in terms of under-regulation in Europe, a couple of things. One of which was that European regulators relied far too heavily on the Fitches and the Standards and Poor's in assessing the right of European banks to hold collateral that that in turn has turned out to prove toxic. So that one of the things that the European regulatory system has been guilty of is naivete in terms of the credibility of their European peers and colleagues. There has been much talk about establishing an independent European regulatory system that would in effect amount to a European Standard and Poor's, but to date that has not come to pass. So that's one issue. The second issue is that much of banking activity, a strikingly large amount of financial activity takes place in deep shadows in Europe by the use of corporations that are essentially opaque in places like Liechtenstein, the Isle of Man, Jersey, etc., or bank accounts in places like Switzerland. What's happening now is that even conservative governments are so starved for revenue that they've turned against the Swiss and the Liechtensteinians over the course of the last 4 or 5 years, and so some of that may be changing. And I think there is still a lot of room for even further removal of the ability to move money offshore and to keep it hidden from national authorities that would benefit all of us if it were pushed forward on a more global basis. But that, again, is an issue. The third, I think, is that the European banking system, like the American banking system, became enamored of value at risk. And the idea that risk officers of the banks could effectively calculate the risk coefficient of major assets that the bank was holding and use those risk-evaluated numbers in calculating things like the amount of capital that needed to be held under Basel rules of recent years. We should know by now that VAR is an inexact game and not a science as one would like to think of science as being. But I still don't see a willingness to turn away from some variations off of VAR or risk-weighted valuing of assets in terms of capital requirements for these big banks. What you've seen in the last 6 months is the European regulators have actually let some of these banks get away with incredible sort of tweaking of their books using accounting rules in order to get them up to a full top-off of their capital requirements, which again speaks to the corruption of the regulators and the weakness of the regulators in the face of the power and the economic and political power of the big banks of Europe.
We have, yes, please come forward. We are running out of time, so please be succinct if you would be so kind. I'm sorry, and then you're the second, and he's the third.
So it seemed to me that the Enron accounting crisis that you referred to earlier occurred before 9/11. I don't know whether this is true, but I know that Enron went down and Arthur Andersen, and there were a whole series of disasters. I believe that happened in like 2000. Is that the question? Is that correct?
Yeah.
And it's what seems to have happened is that 9/11 has had the effect of making everyone, especially me. I mean, I can speak for myself certainly. Forget about those things. And I'm wondering whether they might have had something to do with the 2007 meltdown, logically, or, you know, I mean, whether you could trace some causal connection between those systemic accounting failures and the failures of 2007 through 9, and I'll leave it at that, since you said to be succinct.
To give you a succinct answer, it's quite clear that systemic accounting failures and oversight failures by internal officials in many of these companies was a large part of the failure. I think immediately of AIG, for example, in which its valuation of the probabilities of default on the part of these bonds that it was insuring was just wildly off the mark, and there was no competent understanding from headquarters in New York, as far as we can see in retrospect, of how much risk, how much liability the London office had taken on that led essentially to the public and the federal government having to pick up AIG's mess to the tune of, what, I think 120 billion so far, maybe a little bit more. I don't know what the latest number is.
The movie Inside Job, for the past year, having seen it twice, I'll be closing, hopefully before the election, international coverage of every square inch of the globe with cable TV. I want to get it out simultaneously. What is your opinion of the movie?
Well, I think it's a very good, polemical, and yet insightful and broadly accurate film. You know, I arranged to have it screened at the Kennedy School a year ago, a year ago. So I think that it is worthwhile having many people see it. So in that, I have no objection.
Could you just say the name of the movie for our...
Inside Job by Charles Ferguson, who's an MIT PhD who did a quite good job. I mean, Harvard Economics Department is not happy with it, but there are many things that Harvard Economics Department is not happy with.
In my opinion, it looks difficult for the European countries to solve that crisis by themselves. Then could China be the solution to solve this problem? Because from the China's point of view, the European debt crisis could be a very good chance to increase their its influence in Europe. So, and then besides, the Europe is the main, Chinese main, the customer to buy its product. So how do you think about this problem?
So this is an important idea. It's not a new idea, and I assure you that senior figures of the Greek government spent a good deal of time in Beijing talking with the Chinese government about these prospects, and it resulted in 5 billion euros worth of Chinese investment in Greece. So the promise is there. The reality is not. China seems, for a variety of reasons, willing to leave the status quo alone by and large. There is some unconfirmed, because China won't confirm it, some unconfirmed news that China has been shifting its currency reserves more heavily into euros and out of dollars. But other people have responded that this is just a function of the Chinese normally rebalancing depending on trade weighting, not some significant policy shift in which it is tilting toward the euro. So, you know, obviously in a textbook sense or in a magazine sense, this is sort of an obvious play, but the Chinese don't seem inclined to play it. So.
Last question.
Oh, okay.
Yes,
Okay.
please.
My question has to do with credit default swaps and the role they played in terms of Greece's massive debt issues, and how Goldman Sachs also played a role in sort of helping Greece cook the books and not let the regulators or European Union know what was happening before it became, you know, a catastrophe.
So I think you're talking about the period of the early 2000s when Greece was preparing to try to enter the Eurozone, and turn to Goldman Sachs for structured financial instruments. Is that what you're?
Mm-hmm. Yes, I am.
Okay.
Yes,
That happened. It happened in Germany, it happened in Italy, it happened in France. J.P. Morgan and Goldman were quite active across the continent in that period because there was a lot of dressing up of books for a whole lot of reasons by a number of countries. It turns out that the size of the Goldman Sachs product is on the order of about 10 or 15 billion euros. So it's not within the context of the 400 and some billion euros that Greece now owes a significant factor. And in truth, you know, looking at what was being done, I could make an argument that, you know, irrespective of what Goldman got as a fee, that it might not have been a bad idea to do what they did, which is essentially they were capturing future revenue from things like toll roads and moving that cash forward to try to clean up their balance sheets. As long as the discounted future value of those tolls wasn't completely miscalculated to Goldman's benefit, you know, this is something that corporations and U.S. government, below the federal level, government entities do all the time here in the United States. So I'm not one for letting Goldman off the hook by any means in this situation. I just don't think that that's as significant as people think it was in terms of the overall problems that Greece had.
And just on credit default swaps in terms of the amount of swaps that have been issued, I mean, it runs into the tens of trillions of dollars. I mean, that certainly must have contributed to it. Certainly with AIG it did, because the insurance that they were buying was certainly way over, you know, way over.
I'm sorry, I thought I was responding specifically to the Greek situation. I apologize, I misunderstood you.
Well, that too, and then this is just the other thing was with, it's, I guess, two separate questions. The first one is about the credit default swaps and just the role they played in just this economic meltdown here in the country and in the U.S. and also, I'm sure, obviously, it contributed to what happened in Europe as well, too.
Sure. Well, I mean, we know that credit default swaps played a large role, not a determinative role, but were part of this whole process of creating what amounted to opaque liabilities that weren't fully understood even by counterparties and certainly not by the larger financial world, and that's part of the problem of allowing these kinds of both opaque instruments and opaque firm operations to keep going. I mean, hedge funds that were based in Fairfield, Connecticut, but operate as if they were incorporated in the Cayman Islands were doing business in 2008, and they're doing business in 2012. And right now, the SEC and the federal government don't know a heck of a lot more about those operations or their market impact than they did in 2008 or 2007, and I consider that to be dangerous.
Thank you, Richard Parker. Thank you very much indeed.